more than 10 years. On my background, actually, I am doing lectures at IBSL. Some of you may know me because I am doing the financial management lecture for the diploma course. And for that also, I am doing those lectures since 2015. So almost more than 5 years, I am doing lectures at IBSL. I think that's all on my introduction. I hope some of you are working for Treasury, no? Commercial bank treasuries are working for treasuries. Okay, it seems that nobody is talking. is it the normal thing in the class? Or you are free to ask any questions and you are free to interrupt at any time. If you don't get understand anything, you can stop me and ask any question. So don't worry, you can ask any question. Okay, so today the topic is money market instrument. Before that, what did you learn previously on this lecture? What did you learn previously apart from this today's money market lecture? Before that, what did you learn? In order for me to get some idea what are the things you know. So what did you learn before this? What did you learn? Seems nobody is talking, no?
We learned about financial markets, sir.
Sorry?
Financial markets,
Okay.
and after that, we did time value of money
Okay.
and maturity dates.
Okay. Okay.
Yeah, so those three we did before, and today we have to do money markets.
Yeah. I think before doing the money market, you should know something on time value of money. Without that, we can't do money market instrument. That I want to know whether you have done time value of money.
Yes.
And under that, you should be able to calculate the present value, future value, and those things.
Yes.
Okay.
Yes.
Okay. Right. Good. So let me share the presentation for today. Uh, this is the money market presentation. I hope you all got the presentation. I think the IBSL have uploaded this presentation to the folder, so it may be available in your folder. So please get a copy from there. These are the topics we have to learn today. Role of money market segments, participants, instrument, treasury bill, interbank, purchase agreements. When we take the market, we can divide the market into two types based on the maturity of the instrument. So based on the maturities, we can hope you can see my screen also. Based on the maturities, we can divide market into two parts. One is money market. Other one is the capital market. Money market, the special thing is these are short-term instruments. In money market, all these instruments are short-term instruments. So the maturity will be less than 1 year. Uh, if you are not talking or asking any questions, please mute your mic. When, when you want to ask a question only, please unmute. Okay. So if you take money market, all of them are short-term instrument and the maturity will be less than 1 year. When we take to capital market, they are long-term instruments. So their maturity will be more than 1 year. So based on the maturities, we can divide the market into two types, money market and capital market. Under capital market, you will learn about bond market, Uh, equity. Equity means you will learn about ordinary shares, preference shares, preference shares, debentures, long-term loans. So you will learn these things under capital market in future. In future, with your normal lecture, you will learn about these markets. But today, our topic is money market. So all these instruments are maturing less than 1 year, and you will not get periodic coupons. There won't be any periodic coupons. There won't be periodic coupons. If you take the capital market, there will be coupons. So this is basic introduction to these two markets, money market and capital market, based on the maturities. So we can simply say whatever the instruments which are maturing less than 1 year, those are money market instruments. And why we need a money market? Why? What's the importance of a money market? Why money market is important? If you have any short-term liquidity concern, then the money market is important. If you are short in cash for a short period, then the money market is important. And this money market is important for both corporates and government as well. Okay, because government is also borrowing from the market, not only the corporates or the companies, government also borrowing from the market. So when the government has short-term financing issue, they will issue short-term instruments and get money from the market. Okay. So this is your presentation. So the definition, as we discussed, it is exchange of short-term instruments. All these instruments are maturing in less than 1 year. The maximum maturity of the money market instrument will be 1 year, and this market is highly liquid, and the risk is less compared to long-term capital market instruments. Money market instrument, the risk is less, and this market is highly liquid. Highly liquid means you can borrow any amount or you can lend any amount easily. That's why this market is highly liquid. And when the banks has temporary surplus plus, when the bank has temporary surplus funds or shortage of funds, then the money market is important. And when we think about the government, when the government has short-term needs, then they will issue treasury bills. So you all know about treasury bills. So the treasury bills are issued by government, and always, not always, what I can say is most of the time, these treasury bills are issued at a discount. What do you mean by discount? Normally, all the treasury bills are issued at a discount. What do you mean by discount? Discount means issued price is less than the face value. If the face value is 100, issue value should be less than 100. That's why it is known as a discounted instrument. Normally, all these money market instruments are discounted instrument. Why? Most of the time, they are issued at a price less than the face value. Face value is the amount you are going to receive on the maturity date. Always, not always. We can't say always, but most of the time, they are issued at a discounted price. And bank certificates of deposits are issued by banks. It's kind of fixed deposit certificates, isn't it? So they are issued by banks, and the commercial papers are issued by corporates and companies. That is the equivalent of treasury bills. The treasury bills are for government, for others the commercial papers. That all can't issue commercial papers. To issue commercial papers, you should have a good reputation. If you don't have a good reputation, you can't issue commercial papers. Nobody will buy it. So in order to issue commercial papers, you need to have some reputation in the market. If you don't have a good reputation, you can't issue commercial papers. Okay, so these are the common instruments in the money market. And we have federal funds. Federal funds means exchange of excess and deficit reserves between banks on an overnight basis. So when banks have excess reserves, so they can exchange within the banks. Say one bank has a surplus, one bank has a negative, then both of these bank can discuss and exchange this fund for a temporary period. Most of the time, it is overnight basis. Overnight means if you deposit today, it will mature on next day. So only one day is there for federal funds. There's something called interbank or money market. So that is lending and borrowing among banks are when banks borrow and lend money within themselves on overnight basis. It is called interbank or money market. So again, it's a one day. There's only one day for this instrument. And we have repo and reverse purchase agreements. So we will come back to that later. Okay, but I will give you a small introduction to repurchase and reverse repurchase agreements. Say we have bank A here. We have bank B here. So what the bank A will do is they will give some securities. It can be T-bills, bonds, like that. So the bank A will give securities to the bank B as collateral. As collateral, bank A will give some securities to the bank B. So based on the value of the securities, bank will give some money to bank A. So this is known as repo. So if you take this contract from the side of bank A, it is known as repurchase agreement, or it is known as repo. In short, we use repo for this kind of arrangement. It's known as repo agreement. In a repo, what will happen is you will borrow some money by keeping some securities as collateral. It is known as repo market. When we think from bank B side, it is known as reverse repo. The bank B is lending money. The bank B is lending money by taking securities as collateral. So the lending party is known as reverse repo. Borrowing party is known as the repo party. So this is simply repo and reverse repo. I think now you have some idea about repo and reverse repo. Okay. Any questions up to now? Repo and reverse repo. Okay. If I ask a question like this, what is the best method for you to lend surplus money? Say you have some surplus money. So what's the best method for you to invest this surplus money? So what's the best method? If you have surplus money for a short-term period, what kind of instrument can you use in that case? What kind of instrument can you use? Anyone? It's in your
Treasury
screen.
bills?
It's in your screen actually.
Reverse repo.
Reverse repo. Okay, that's the best method for you to invest your surplus money. So if you have surplus money, you can use reverse repo. If you have a deficit, what can you do? You can do repo,
Repo.
isn't it? Yeah, if you have deficit, you can use repo. If you have surplus money, you can use reverse repo. So when you are working for Treasury, so you may have to use this instrument when you have deficit or surplus. Only thing is, for you to do repo and reverse repo, you should have some securities. Without securities, you can't do repo and reverse repo. That's why in most of the commercial banks, if you take their balance sheet, they have treasury bills, treasury bonds, isn't it? So they have invested in those securities. The benefit of that is, if you have a shortage of money, you can keep them as collateral and get some money. Since you are giving some good collateral, the borrowing rate is less compared to other instruments. Okay. And now you have some idea about repo and reverse repo. Okay, so these are the types of money market instrument. So all are maturing in less than 1 year. Most of them are issued at a discount. So the discount means if the face value is 100, they are issued at less than 100. Okay. So you know about face value, no? Face value is the amount that you are going to receive on the maturity date. So you all know about those things. Okay, now we'll go to the role of money market. Why we need money market? I think we already discussed this thing. The main purpose of money market is to facilitate the transfer of short-term funds from agent to excess funds. Before that, I will draw another chart. So in the market, we have surplus parties. Surplus means people who have excess money. And we have people who have deficit. Deficit party. It means they have shortage of money. You know, in economics, we learn that households have the surplus money, isn't it? Households. In Sinhala, we name them as Kutumba. If you have done commerce for your all your sales A-levels, so you will remember. So we say for households, in Sinhala we say Kutumba. So all the households will have the surplus money. Normally the companies or the investors have the deficit. So now what we do from the market, we need to bring these parties together, isn't it? So we need to somehow we need to bring them together. So the surplus party need to invest, whereas deficit party need money for their investments. So for that, there are two financing methods in the market. One is called direct financing, other one is called indirect financing. Indirect financing is between these two parties, there's another party. Normally in Sri Lanka, we can say bank are the intermediate party. So surplus units, what they will do is they will deposit their surplus money with bank. So they will deposit their surplus money in a bank, and bank will lend that money to the deficit party. So this is known as indirect finance. Okay, so this is known as indirect finance. Why it is indirect? Because between deficit and surplus party, there's another one. In Sri Lanka, we can say a bank. So the surplus party will deposit money with the bank, and bank will lend that money to the deficit party. So normally what happens in Sri Lanka, we place deposit at 4%, the bank will lend them at 8 or 9%. So bank has a margin of 4%, isn't it? So that's what currently happening in Sri Lanka. Normally in Sri Lanka, the bank has a huge margin compared to international market. Other method is the direct finance. So in direct finance, what will happen is these deficit units issue some instruments, like they will issue shares, they will issue bonds or they will issue money market instruments. Okay. So deficit parties will issue various kinds of instruments, financial instruments like shares, bonds, money market instruments. Likewise, they will issue financial instrument and the surplus party will buy those instruments. So in that market is known as the direct finance. So we have two types, direct and indirect. In a direct market, deficit units will issue financial instruments and surplus unit will buy those financial instruments. So this is the mechanism where surplus money is flowing to the deficit unit in a market. So this is all together, it's known as financial market, isn't it? Okay. So now you have some idea about direct finance and indirect finance. For a country, what is most important, direct or indirect? In developed countries, what is most common, direct or indirect? If you have a developed financial market, what is most important, direct or indirect?
Direct.
Direct. If you have a well-developed financial market, so direct market is important. But since Sri Lanka, we don't have a very developed financial market, so we have this market is important for Sri Lanka. But you know, if it is indirect, we are paying a huge commission for banks, isn't it? They are taking a margin of 4%, isn't it? Just they take 4% from both parties, isn't it? So if you have direct finance, this 4% is not there. So it's more cheaper for both surplus and deficit party. If we have a good financial market, so they can easily fund their deficit at a lesser cost compared to indirect finance. Okay. There are pros and cons, but we'll see. Okay, so this money market is in the direct finance, and sometimes we can see money market in indirect finance as well. If we take certificate of deposits, it's in indirect finance. But if we take treasury bills, commercial papers, it's in the direct finance market. 50% left in my laptop. Until that run off, we'll do the lecture. Sorry, because I didn't thought there will be a power cut today. So otherwise I could have gone to IBSL and done the lecture. Sorry about that. So we'll continue until I have the power. Okay. So we were discussing about, let me share my presentation. You all have power in your areas? Should be, no? That's
Yes,
why you
sir.
all
Yes, sir.
Okay, so the first time actually I had a power cut. So in my area, normally there's no power cut. I don't know why it happened today. Maybe someone has complained about this. I don't know. We'll see. Okay. Okay, so this is a role of money market. Hope you could see my screen. The purpose of money market is to facilitate the transfer of short-term funds from agents with excess funds to those market participants who lack funds for short-term needs. So we discussed that part. Under direct and indirect finance, the money market is for short-term. If you have short-term excess funds or short-term deficit, then you can use money market. So the main purpose is to invest your short-term surplus fund or to get funds if you have any short-term deficit. So that's the main purpose in a money market. So they play a central role in the country's financial system by influencing it through monetary policy central bank of Sri Lanka. So central bank also influence in this market. You know that central bank conducts the monetary policy in Sri Lanka. So what do you mean by monetary policy? And you will have some lectures on central bank also. So what is monetary policy? Under monetary policy, what the central bank is doing? What they do? For a treasury, activities of central bank is really important. Whether you like it or not, it's really important. And one thing to say that in this lecture, since I am working for the central bank, whatever the opinions or ideas expressed by me, those are my personal ones, not the central bank ones. Central bank may be having different opinion compared to me. Okay, so what the central bank is doing under monetary policy?
Controls money supply.
Yeah, if you take the market, so if you take a market, so this is the money demand. So people demand money for various purposes. I think you know about that. Transaction purpose, precautionary purpose, and speculative purpose. People will demand money. So this is the money demand graph. So this is the interest rate. This area is the interest rate. And this is the money supply. So this is the money supply is handled by central bank. Central bank can control the money supply in the market. And this is the equilibrium interest rate in the market. So this is how interest rate is determined in the market. Say now our inflation is around 12%, isn't it? And that will go up further, isn't it? Unfortunately, with the incidents happening in Russia and Ukraine, it will have some impact to Sri Lanka, isn't it? It will further worsen the situation in Sri Lanka. And now you heard that US and Europe, they are going to put some sanctions to Russia. It means there will be a hit for our tea exports because I think around 20-30% of our tea is going to Russia and Ukraine. So there will be a huge impact for tea industry. And with that, again, our foreign exchange situation will further worsen because of that. And the other main thing is, you see now what's happening to oil prices. It has gone. Now the barrel is more than 100, isn't it? So what's the maximum, if you take the history, what's the maximum price for oil for a 1 barrel? What's the maximum price? At one time, oil price went to at what price? If you know the history, what's the maximum price for oil? What's the maximum price? I think oil went up to $147 per barrel. That's the maximum value for crude oil. It has went up to 147. I think it's happened in somewhere in 2007 or 8. If I'm not mistaken, it's happened in that period. It went up to $147 per barrel. Now it has gone up to, I think, 106 or 107 now. So it means further our oil prices should go up in Sri Lanka, isn't it? And central bank is also asking the government to increase the oil prices. Government is not doing that. And that will happen is there will be huge losses to the Ceylon Petroleum Corporation. And ultimately that loss will pass on to us, isn't it? In kind of taxes, and somehow it will pass to people of Sri Lanka. So we have repeatedly asking government to increase the oil price. The government is not doing it. I don't know. What will happen is ultimately the oil prices should go up. With that, Sri Lankan inflation will further increase. So in that case, what will the central bank do under monetary policy if inflation is going up? Because one of the main objectives of central bank is the price stability. So in order to achieve that price stability, what can central bank do when there's a huge inflation, high inflation rate? What the central bank can do under monetary policy? If anyone knows something on that, what they will do is they will reduce the money supply in the market. So how can they reduce the money supply? They have several tools. We have some tools, isn't it? So we have some tools in our hands, so we can use them to reduce the money supply. Like we reduce the money supply, what will happen? The equilibrium interest rate will go up. So that's what happened in Sri Lanka. In coming months, our interest rates should go up. Why? Definitely, central bank need to do something to control the inflation. Only thing available for central bank is to reduce the money supply. When the money supply is reduced, definitely our interest rate will go up. And the other thing is, in order to protect our exchange rate, now it's kind of fixed now around 203. Again, my personal opinion is our rupee should depreciate. Otherwise, this current situation will get further worsened if we are to keep the exchange rate at this level. That's my personal opinion, not the central bank's opinion. Anyway, so in order to keep the exchange rate at these levels also, central bank need to raise the interest rate. So that's what central bank is currently doing under the monetary policy. They are slowly increasing the interest rate. So in coming months, the interest rates will go up in Sri Lanka. Under time value of money, when the interest rate goes up, what will happen to the value? Do you have learned that, no? If the market interest rate is going up, what will happen to the value? What will happen? What will happen to the values of financial instruments if interest rates are going up?
Decreasing.
Decrease. We know that interest rate and value has a negative relationship. Whenever the interest rates are going up, value should come down. What should happen? Share market, we see it's crashing, no? So share market, share prices should come down, land value should come down. So all these things, prices should come down in future. So if you are planning to invest, keep a note on that. So there can be a possibility of these prices coming down in coming months. So this is the situation. So whenever there's a high inflation, central bank will come and reduce the money supply. With that, interest rate will go up. So so that's how central bank is influencing this market, isn't it? Okay. And for you also, these days, if you have some excess money, think about the treasury bill market, because if you put a deposit in a bank, now I think you will get only 4 or 5%, isn't it? But if you invest money in treasury bills, you all can do that. You can get around 8.2% these days. So from your commercial banks, you can buy treasury bills. So keep a note on that also. At least you will earn something. But this is also not enough these days. Why? When the inflation is around 12%, if you are earning 8.2% means you have a loss of 4%. But it's better than keeping money in a bank account. At least you will get some extra. And treasury bills are more safe because it's issued by government. If the government don't have money, what can they do? If the government don't have money to pay the treasury bill, what can they do? At least they can increase taxes and pay these treasury bills, or they can ask central bank to print some money, isn't it? Okay, either way you will get paid. So these treasury bills are more safer compared to the bank deposits, and you can get a higher return as well. So please make a note on that. So if you have excess money, think about the treasury bill market as well. Okay. Okay, so this is the role of money market, and these are the money market functions. So money markets allow for executing mainly the following functions for financial institutions and to some extent to other non-financial institutions. So money market will help to raise funds if you have a short-term funding issue. If you have working capital issue, money market is important. You can raise some short-term funds using the money market. And if you have, it can be used in cash management. If you have excess, you can invest in money market. You have deficit, you can borrow from the money market. It can be used in the risk management. It can be used in speculation. What do you mean by speculation? Do you have any idea about speculation? In Sinhala we say samapekshana. What do you mean by speculation? What do you mean by speculation? Speculation means if you are entering into the market with the view of making profit, that is known as speculation. In a market, investors come to market for two purposes. One for hedging. They come from market for hedging. Other one is for speculation. The one is for arbitration. So these are the key main purposes why people come to market. Hedging means in order to mitigate the risk, minimize the risk, so they will come to financial market. So this is known as hedging. Speculation is main objective is making profit. Arbitration means earning riskless profits, earning profit without taking risk. That is known as arbitration. For example, for arbitration is, let's say in PETA. So this pen, say PETA, it's 10 rupees. And in Maharagama, this pen is 20 rupees. So what can you do? In PETA, it's 10 rupees. In Maharagama, it is 20 rupees. What can you do? If there's a price anomaly, then there's an arbitrage opportunity. So what can you do? You can buy this pen for 10 rupees in PETA, and you can come to Maharagama and sell it for 20 rupees. Then you can earn 10 rupees more, isn't it? So that is known as arbitration. So this is why people come to market: hedging, speculation, and arbitration. Okay, so you will learn these things in future in next lectures. Okay, so these are the main functions: fundraising, cash management, risk management, speculation, signaling. Signaling means by looking at the financial instrument in the money market, you can get some idea what will happen in future. Say if people expect interest rates to go up, then the money market rates will be high. Normally, that's what happens. If people are thinking that interest rate will go up, then what will happen is money market rates also will go up. So it's kind of a signaling thing. So if you see money market rates are going up, means in future market interest rates also will go up. So it's kind of a signaling thing. And it will provide access to information on prices. And money market is a wholesale market with enormous transactions. It means hundreds and thousands of transactions are happening in the money market. That's why it's a liquid market. Okay, any questions up to now? Maybe it's kind of a boring because we are not doing any calculations right now, just some theory, isn't it? Okay. Since you have in your exam paper, first question has 40 marks. So for that, for multiple choice, these theory parts may be important. Okay, any questions up to now? Any issues? Any questions or any issues up to now? Okay. Next one is the money market segments. So money market consists of market for short-term funds, usually with maturity up to 1 year. So in a money market, we already discussed these things. Always the maturity is less than 1 year, and we can divide this market into several segments. First one is interbank market. So in an interbank market means the market between banks. It is not open for us. It's a it's a market between the two banks. So where banks and non-bank financial institutions settle contract with each other with an central bank involving temporary liquid surplus and deficit. So in an interbank market, we will find all the commercial bank, all the finance companies, all the leasing companies, even central bank are in the interbank market. So they will do trades each other. If they have any excess fund, so they can go to the interbank market and invest that excess fund. Or if they have any short-term deficit, so they can go to the interbank market and borrow money. And there's something called primary and secondary market. Did you learn about primary and secondary market? Did you learn anything on primary and secondary market? Did you learn or not? Do you have any idea about secondary and primary market? Or do we have or not? Okay. So I will explain what is primary and secondary market. And divide market into primary and secondary. In a primary market, you will find issuers and investors. So this primary and secondary mainly in the direct finance market, direct financing market. So we discussed direct financing. So in a primary market, you will find issuers and investors. In a secondary market, you only find investors. In a primary market, all the issuers means we can take central government is issuer, commercial banks, companies, all can be issuers, isn't it? So they can issue various financial instruments, bonds, bills, commercial papers, stocks, anything. So they will issue various financial instruments. So investors will buy these financial instruments. So in this primary market, the money will be directly go to the issuers. So if someone has a deficit, so they need to come to the primary market and issue some financial instruments. Then only they can find money for their deficit. In a secondary market, what will happen is these issued securities like bonds, bills, shares. So it will be traded between the investors. So it will be traded between investors. So that market is the secondary market. So if you take Colombo Stock Exchange, CSE is a secondary market. Why? What happened is the shares are exchanged between investors, isn't it? The issuer is not there. The shares are traded between investors. So the special thing in secondary market, always, whatever the instruments in the primary market will be traded among investors. So that is the secondary market. So now you will have some idea about primary and secondary market. Okay. So primary market, which is absorbing the issues and enabling borrowers to raise new funds. So borrowers will raise new funds in the primary market. So please remember, borrowers can't raise new funds in the secondary market. You can only raise funds in the primary market. The secondary market for different short-term securities, which redistributes ownership, ensures liquidity, and as a result, increases the supply of lending and reduces its prices. So what will happen is, whatever the financial instruments issued in the primary market will be exchanged among investors. So that will happen in the secondary market. And the derivative market for financial contract whose values are derived from the underlying money market instruments. So you will learn about derivative markets later. If you take derivative market, there are several instruments like options, swaps, interest rate swaps, forward rate agreements, futures, forwards. So there are various financial instruments in the derivative market. So you will learn them later. So if you take money market instruments, the money market instruments are often grouped in following way: treasury bills and other short-term government securities. So if the government needs short-term money, so they normally issue treasury bills. So normally treasury bills are matures in 1 month time, 3 month time, 6 month time, and 1 year. So normally in those tenors you can buy treasury bills. As I mentioned previously, nowadays rather than putting deposit, you can buy treasury bills. By doing that, you can get a higher rate. So please make a note on that. So at least you can get something by listening to my lecture by investing in treasury bills. And there can be interbank loans, deposit, and other bank liabilities. So there can be instrument in the interbank market as well, and repurchase agreement and similar collateralized short-term loans. So repurchase agreements we discussed. So these are the money market instruments. And we have commercial papers. If government issued a short-term instrument, it is known as treasury bill. If a company issued it, it is known as commercial papers. And we have certificate of deposits, euro currency instruments. Euro currency instrument means if a Sri Lankan bank get a dollar deposit, it is known as a euro currency deposit, because Sri Lanka, the main currency is rupees. If you get any deposit other than rupees, say in euro, GBP, dollar, then everything is known as euro currency deposits. There are interest rate and currency derivative instruments as well. So these are the main instrument types in the money market. Okay, so we discussed these things, isn't it? It's coming again. And some of these money market instruments can be traded in the secondary market, not all. Some can be traded in the secondary market. So example, you can trade treasury bills, commercial papers, certificate deposits. You can trade in the secondary market. So it is known as tradable instrument. That's why it is known as tradable instrument. There are some, it's not tradable, so cannot be traded. For example, interbank loans, repo, some CDs, it is not possible to trade. So it's known as non-tradable instruments. So these are the participants. I think we discussed. No need to discuss again. Okay, so we'll discuss about treasury bills. Treasury bills are issued by the government. My battery only 28% is left. Until that, we'll continue the lecture. Still, I didn't get the power. Hopefully, if we got the power, we'll continue. If not, we will stop. Off. We'll see. Based on the battery level, we'll stop the class. Sorry for that. Anyway, we'll continue. Treasury bill. Treasury bills are issued by the government. The maturity is less than 1 year. And these treasury bills are known as risk-free instruments. Why it's risk-free? Why it's risk-free? Why it's risk-free?
Issued by government.
Yes, issued by government. Why it's risk-free?
Government will definitely repay.
Yes, say Sri Lankan government issued a USD treasury bill. Is it risk-free? Will it be risk-free? Will it be risk-free? So we have some development bonds, isn't it? Issued by Sri Lankan government. Are they risk-free? No, isn't it? Why? The government need dollars to repay. If Sri Lankan government issued dollar bonds or bills, it is not risk-free. Why? We can't print dollars, isn't it? Legally, we can't print dollars and pay. Because of that, if Sri Lankan government issue treasury bills in dollars or euro, then they are not risk-free. Only case if Sri Lankan government issues treasury bill in Sri Lankan rupees, then in that case, those bills are risk-free. Why? If the government don't have money, they can do two things. One thing is they can impose some new taxes, and using that money, they can prepay the treasury bill. Or else, what they can do is they can ask central bank to print some money, isn't it? So by doing that also they can pay the treasury bills. So that's why it is known as risk-free, because they don't have any credit risk. And also this treasury bills rate is known as risk-free rate in the market. So treasury bill interest rate is known as risk-free interest rate because of this reason. The interest rate of treasury bills serves as benchmark default-free interest rate. So these rates are taken as a benchmark rate in the market. So the typical maturity of treasury bills are 91, 182, and 364. These are the typical maturities for any treasury bill in Sri Lanka. They don't have any coupons, and these are zero coupon instruments. Zero coupon means they don't have any periodic coupon, and in Sri Lanka they are issued at a discount. So discount means it's issued at a price lesser than the face value. I think we discussed that part also. Always treasury bills issued at a discount. Okay. So price of a treasury bill is the price that an investor will pay for a particular maturity treasury security depending upon the. So in order to buy treasury bill, we need to pay some amount. That paid amount is known as price. So again, the price is determined using the present value formula. I think you all know about present value formula, isn't it? So we have to use that formula in order to derive the price. And some treasury bill does not guarantee interest payment and value of present value of par value. Okay, we will come back to that point later. So again, we need to know that present value formula, because using the present value formula, we can determine the price of a treasury bill. So by taking the present value of face value, you can get the price of treasury bill. Treasury bills don't pay interest. Investors will pay a price that will ensure that the amount they receive maturity will generate a desired return. Okay, so the meaning is that, say the face value is 100 and we buy a treasury bill at 96. So what is my interest income? I buy the treasury bill for 96 and the face value is 100. Will there be an interest income for me? Will there be interest income? Or will there be a gain for me by investing in this treasury bill? For treasury bills, you will not get any coupons. So any benefit of investing in this treasury bill? Any benefit? Any benefit? Can anyone tell me about a benefit of investing in treasury bill? Is there any benefit? Without benefit, people will not invest, isn't it? So is there any benefit of investing in this treasury bill? There's a benefit, isn't it? Although you invest 96, on the maturity date, you will get 100. So this 4 rupee will be your benefit. This 4 rupee will be your benefit of investing in this treasury bill. Okay. Any questions up to now? Now we are going to do some calculations. So before that, any questions? Any questions? Okay. So in order to calculate the discount, so discount is simply you need to deduct the price from the face value, then you will get the discount. And in this case, in my example, face value is 100 and the price is 96 and the discount is 4 rupees. So this is known as discount. So discount is the difference between face value and the price. So that is known as discount. In Sri Lanka, always treasury bills will be issued at a discount. Globally, can we say all the treasury bills are globally, can we say all the treasury bills are issued at a discount? Can we say? In Sri Lanka, this is correct. If we take another country, will this be correct or not? If I give a statement like this, treasury bills are always issued at a discount. Is it correct or wrong?
Not correct.
Not correct. Why? Always is the issue. It is not always. Why? Why? In Sri Lanka, it's correct. Always issued at a discount. But if you take a country like Germany, it is not. Why? Or Japan, it's not. Why? Why? Sorry? Why? In Germany, Japan, they are issued at a premium. Correct. You are correct. Premium means issued price is higher than the face value. So if the face value is 100, they are issued at say 102. So you take Germany and Japan, they are issued at a premium. Why? Why in Germany and Japan issued at a premium, whereas in Sri Lanka, they are issued at a discount? Why? Any idea? Any idea on this? Any idea? The main reason is in these countries, if you take German and Japan, they have negative interest rates. They have negative interest rates. That's why they are issued at a premium. Why they have negative interest rate? Why they have negative interest rate? What is the meaning of negative interest rate? Why they have negative interest rates? Why they have negative interest rate? Any idea? Why they have negative interest rates? Negative interest rate means if we place a deposit, we will get some interest, but in that country, if we place a deposit, we need to pay interest to the bank. That's why it's known as negative interest rate. So in this case, we buy the treasury bill for 102, but on the mature date we only receive 100. So there's a loss of 2. So if that's the case in Japan and Germany, they have negative interest rate because they don't have inflation. They have deflation. That's why they have negative interest rate. Okay. So now we know how to calculate discount. You need to deduct price from the face value, then you will get the discount. Then we need to calculate the discount rate. The discount rate is simply, you should know this formula. Simply you need to do is you have to divide the discount from the face value, then you need to annualize it. So that's how you derive the discount rate. So I will give you the formula for discount rate. Okay. Discount rate formula is face value minus price divided by face value into we use 364 in Sri Lanka for treasury bill and in the divide by investment period. And you need to multiply 100, you need to get the percentage value. So what you have to do is face value minus price divided by face value into 364 divided by investment period. So this is the discount. So in order to get the discount rate, what you have to do, you have to divide discount by face value into 364, divide by investment period into 100. Then you can get the discount rate. Okay. So here you have an example. Suppose you could buy a 364-day treasury bill at a price of 90 and the face value is 100. Calculate the discount rate. So what's the discount? Simply face value minus price will be discount. Face value is 100, price is 90. So the discount is 10. What you have to do is you have to divide discount by the face value into 364. And since the maturity and the investment period are same, so 364 divided by 364 comes to 1. So that's why the rate has become 10%. So now you know how to calculate discount rate. So I will give you one example. Like, good minute. We will discuss this question from your last exam paper. So before that, can you all see this paper? Can you all see this?
Can see.
Okay.
Can see it, sir.
So before that, what should be the answer for this question number 9? What should be the answer for this question number 9? Primary market we discussed. So what should, okay. So what's the answer for this number 9? Primary market is the place where, what should be the correct answer? So what's the correct answer? Question number 9.
B.
B is the correct answer. Yeah. Because I told you that always issuer is in the primary market. In the secondary market, the issuer is not there, only the investors are there. You will find issuer only in the primary market. I saw the question, giving it, looking for that question. Okay. Can you read this question? You have also purchased a 91-day Treasury bill face value of 1,000 at a yield of 7.5%. Take on basis T64. Okay, I will slightly change this question. Okay, you can write it down like this. You have also purchased a, can write it down the question. You have also purchased a 91-day Treasury bill face value of 1,000 at a discount rate of 10%. You have also purchased a 91-day Treasury bill face value of 1,000 at a discount rate of 7.5%. Take count basis is 364. Calculate the price paid for the Treasury bill. Calculate the price paid for the Treasury bill. Okay, can you all do that? I'll give you 2 minutes. Try to do that. So the question is, you have also purchased a 91-day Treasury bill, face value of 1,000 at a discount rate of 10%. Day count basis is 364. Calculate the price paid for the Treasury bill. Then calculate this. I'll give 2 minutes. Try to do this. Okay, what's the answer? What is the answer? So I will quickly give you the answer because my battery level is now less than 10%. So we'll see. I think I will stop the class after discussing this one. Sorry for that. I don't have power at this moment. I don't know when it will come. So the discount rate is, it says 10%. We'll say by removing the percentage mark, we'll put it as 0.01. And the face value is 100. And the purchase price we don't know. That's what we're going to find, no? Okay, and we'll put it as X, and the face value is 1000, no, not 100. And the day count basis, they are supposed to take 364. In Sri Lanka, it's always 364. And the investment period is 91 days. So now what you have to do is you need to solve this, isn't it? So you can put it in brackets. So this will become 4. So this will become by multiplying this by 4, it's come to 250, and we can do a cross multiplication. 250 25,000 minus X. So X will come here, 1000 minus 25. So answer should be 975. You all got the answer? 975?
Yes, sir.
So this is the issued price. Okay, so in this formula, you will see few factors: discount rate, face value, price, investment period. So these are the main key factors in this formula. If you are given any three out of these 4, you should be able to calculate the left balance one. So there are 4 factors: discount rate, face value, price, and the investment period. So out of that 4, if you are given 3, you should be able to calculate the other one. So you may get questions like this. So it's not difficult. Only thing is you should know the formula. So this is the discount rate formula. Okay, so it's not difficult, isn't it? Easily you can get 5 marks. Okay, so I think that's all I can do today. Sorry for that. I will ask your lecturer to continue the lecture from this slide onward. Sorry for that. Today I don't have power. That unforeseen incident. Okay, and thank you for listening to my lecture. I think we'll stop for today because I don't have power and my laptop power is gone now. So thank you very much. So if you have any questions, you can ask from your lecturer. I think he will do the next lecture. Sorry. Thank you very much.